I was enormously relieved to see a survey in the AFR released this week, which showed that the consensus of Australian economists is that rates will begin to fall in February next year. And the reason I was enormously relieved is because I was happy to find that I'm not in the consensus. And in fact, I think it's practically impossible for rates to fall in the first half of next year. I've got rates beginning to fall perhaps in the third quarter of next year. And the reason for that is, as you'll see as we go through the presentation, some awfully clever decisions that were made by Jim Chalmers, which stem from the fact that he has a PhD in politics, but no PhD in economics. Otherwise, he may have made those decisions a different way. But firstly, what I want to go through is I want to go just touch on the US employment report of Friday, show you our updated model of the Fed funds rate, show you our updated model of the Australian cash rate, and then get into that issue of things that Jim Chalmers has done, which may be good politics, but are really bad economics if you want to put the RBA in a situation where it can cut rates. So US employment number last week surprised on the upside. Growth in jobs, in payroll jobs, was 159,105, which was higher than consensus. And importantly, in terms of our models for the Fed funds rate, it reduced unemployment because falling unemployment pushes up the equilibrium level of the Fed funds rate. Unemployment in Australia has the same effect. But what I've shown before is the idea that the Fed will cut rates as long as the year-on-year rate of growth of employment is below the long-term median. So what I've done is, in looking at the slides today, what I've done is I'm showing slides which deal with just what's been happening this year rather than what's been happening over the period of the full decade, as I previously have, because very small amounts of variation in employment growth rate have a lot of impact in current circumstances. So what you've got here is a chart of US payroll employment year-on-year growth. And what I've shown, when you look at the data for this century, that the Fed tends to hike rates when year-on-year employment growth is stronger than the long-term median, and it tends to cut rates when year-on-year growth is lower than the long-term median. And what actually happened in August is the year-on-year growth rate fell below the long-term median to a year-on-year growth rate of 1.55%, which is just below the long-term growth rate of 1.6%. And that set up the Fed in a situation where it could cut rates, and it cut rates by 50 basis points. So the question is, does that employment number stop the Fed from giving us another 25 basis point rate cut in November and a 25 basis point rate cut in December? No, even though it's a stronger than anticipated number and it generated a kick in bond yields, it's not higher than the long-term median, and so the Fed can provide further cuts. Moving to our model of the Fed funds rate, what we see is the other thing that this is certainly the case in the US is that they've been able to bring down inflation. And they've been able to bring down inflation because their Fed funds rate has been much higher than our Australian cash rate. So in a previous time, in the previous cycle, that is to say back in 2007, they put up rates to exactly the same level, 535 basis points, and we put up rates to 475 basis points. This time, they put up rates to 535 basis points just the same, but we only put up rates to 435 basis points, at least 0.5% below where we were before. And I'll explain the impact of that in a moment. But what we see when we look at our model of the Fed funds rate as opposed to where the Fed funds rate is our estimate is 3.4%. And that's, 140 basis points lower than where the Fed funds rate actually is. So there's plenty of room for the Fed to cut rates. And that's why the Fed will continue to cut rates next month and the month after. But let's look at the situation in Australia. Here we see that we've got a much lower cash rate and our model is much higher. It's been swinging above and below that equilibrium cash rate. The reason for that is that inflation is much higher in Australia. It's about 70 basis points higher. And so the equilibrium level of our model is about 70 basis points higher than in the US. Now, why are the reason? What's the major reason that our interest rates didn't go as high, and as a result of that, our inflation rate is higher? It's because of a condition that Clever Jim, being a very good politician and having a PhD in politics, set upon the RBA with at the beginning of the government of the terms of this government, and that is to say that he made it a condition that yes, the RBA could focus on bringing down inflation, but it could not put up rates to such a point that employment that had been gained in the previous cycle had been lost. And what that did was that put an upper limit on how far the RBA could put up rates. So instead of putting up rates to 475 basis points or to a level that I've been suggesting for some time, that is to say 485 basis points, they got to a peak level of 4.35%. Now, the problem with that is if you can't put up rates high enough, then you can't generate real interest rates which are great enough to put downward pressure on inflation. So the problem here is the upper limits that the Treasurer has set upon RBA rates has generated a situation where it takes much, much longer to bring down inflation than if they'd put up rates in the same way as they did in the previous cycle. Let's move on to the next spread. So that's the first thing that Clever Jim has done to make it more difficult for the RBA to cut rates. The second thing is what he's done with fiscal policy. Now, what we're showing here is a chart from or a table from the budget papers. Now, these budget papers or these estimates will be updated in November in what's called, economists call MYEFO, the mid-year economic forecasts and outlook. And what you'll see is the effect of additional programs that Chalmers has added and how they've increased spending and increased the deficit in comparison to the numbers that you're seeing now. Now, Jim Chalmers has been talking on radio and television and about the surpluses that he achieved. And he did, in fact, achieve a surplus of $22.1 billion in 2022-23, which was 0.9% of GDP. And he did, in fact, achieve a surplus in 22-24 of $9.3 billion, which is 0.3% of GDP. But you must understand that these surpluses were generated at a time when commodity prices and hence corporate profits and payroll and income taxes and other taxes were extremely high because commodity prices were the highest since the 1850s. That is to say, the highest in Australian history. This generated an enormous amount of income, and so even with a higher level of spending, you could generate a surplus. But what happens now is commodity prices fall. What we see that in 2024-25, what Jim Chalmers is going to provide us with is a deficit of $28 billion. And what he's going to provide us with is a deficit in 25-26 is a deficit of $42 billion, or 1.1% of GDP deficit this financial year, and 1.5% deficit, percent of GDP deficit next financial year, which of course provides stimulus to the economy and works in opposition to what the RBA is attempting to do, that is to say, have interest rates high enough to push down inflation. So what this does is it makes it extremely difficult for the RBA to bring down inflation this year, next year, or even in the second half of next year. And hence, I think it's incredibly difficult for the RBA to cut rates in the first half of next year. I think with luck, the circumstances might allow them to cut rates in the second half of next year, but not before August 2025.